Data by Nigeria's Debt Management Office shows that total public debt stood at 121.67 trillion naira at the end of the first quarter of this year. Meanwhile, investors have set their sights on Monday's bond auction as traders at Access Bank say that they expect minimal activities in today's trading. Tobechukwu Ikpe, a Treasury Team Member at Access Bank, joins me now for this discussion. Thank you so much for your time today, Tobechukwu. And let's get a run through of what we've seen play out in the market this week. Yes, it's been a 3-day trading week, but what has been some of the highlights?
Okay, so for this week, for the markets, in the money markets, we saw elevated liquidity due to early fact payments by the federal government and some other discretionary payments that were received by the states that came in on Wednesday. So the money market has been a bit liquid. Consequently, the CBN decided to float an OMO auction on Wednesday, where they offered 500 billion. At the end of the auction, they sold 986 billion with the stop rate for the longest tenor closing at 22.29%. The yield on that is above 28%. So we saw some improved liquidity in the FX market as a result of that. The rates remain stable there, trading between 1,480 to 1,490 levels. So that's what we've seen across the different markets this week so far.
All right, let me get your take on the recent stats from the debt office on the size of debt in the country. 1.6 trillion by the numbers there. We're seeing quite a huge chunk of that coming in the first quarter, 24.4 trillion about that in the first quarter. Let me get your take on how the market is pricing the government's debt strategy into their plans.
So we saw the government debt increase partly due to securitization of ways and means from the previous administration. Recall that last year the National Assembly approved securitization of 22 trillion ways and means that was incurred by the previous administration. So they were able to execute 7 trillion earlier this year. And also the budget deficit for this year was going to be financed by that, by borrowings. So what we've seen in the market is elevated interest rates as a result of that. The borrowing requirement of the federal government and the states have increased drastically, also due to FX pressures and inflation. So to fund their budget deficit, they've come to the market to borrow. We've seen short tenor treasury bills issued at above 25% yields as a result of that. We've seen bonds almost issued at almost 20% as a result of that also. Next week, there's another bond auction where the government plans to borrow more, and the amount on offer there is 600 billion. So we expect that they will try to borrow as much as possible, as much as they can, to continue to finance their needs as the government. But as the debt stock is increasing, one has to keep an eye on the debt service requirements, because issuing bonds at close to 20% coupon for 30 years is a huge cost, a huge burden to the government. So they have to keep an eye on that and make sure they have a sustainable debt profile.
Yeah, we've seen quite a lot shape the market so far this year. We're about to wrap up the first half of the year. We've seen liquidity play a major factor, FX and FX volatility being a key factor there. But for you, as you do a wrap or review of the first half of this year, what would you say were some of the biggest themes for you?
The biggest stories this year for H1 was definitely FX. We saw huge volatility in the first 3 months of the year, the rates swinging from the lows of 900 at the start of the year to as high as almost 1,700 at some point, and it appreciated back to 1,000, around 1,011 levels, then it depreciated again. So we've seen huge volatility in the FX regime as the exchange rate adjustments took place, but now we've settled around the 1,4 to 1,5 levels. Market has continued to receive significant supply at those levels, so I think going forward, the FX rate has kind of stabilized. We've also seen elevated interest rates. The elevated interest rate environment was to tackle inflation as one of the three-headed monsters that is affecting Nigerians. So the inflation rate was one of the major headlines for most of H1. The real interest rate is still negative at this point, but the hope is that going forward from Q3, we should start to see inflation come down and hopefully the interest rate environment relax a little bit. this high interest rate environment obviously has hurt businesses given the high cost of borrowing. So the H1 has been tough for businesses, but there are challenges that the federal government has to tackle in terms of getting this FX supply up, in terms of bringing inflation down. So for the macro environment for H1, it has been a mixed bag with different agenda that the federal government has tried to achieve.
All right. All right, then we'll get to wait to see how the second half of the year plays out. But thank you so much for your time and analysis on the show today. Tobechukwu Ikpe, a Treasury Team Member at Access Bank.